If you aspire to truly command the currents of the market, you must first understand a fundamental, yet often overlooked, truth. The market rarely announces its most significant moves openly. Its surface, like a vast and seemingly placid ocean, often conceals powerful, underlying currents and impending storms. The vast majority of those who venture into this arena remain fixated on the superficial, mesmerized by the obvious, and perpetually distracted by the constant clamor of news, rumors, and fleeting opinions. They see the ripples, but they miss the deep strategic shifts. This superficial focus leads to perpetual frustration and consistent losses. The common trader, armed with the latest headline or a fervent opinion, attempts to predict the market's next move based on what they think should happen, rather than discerning what the market is actually preparing to do. They mistake the visible for the real, the stated for the true, and the immediate for the inevitable. This fundamental misunderstanding of the market's true communication is the first barrier to genuine insight and consistent profitability. The market, in its profound indifference, cares nothing for your hopes, your fears, or your carefully constructed theories. It moves according to its own immutable laws, driven by the relentless interplay of supply and demand, often orchestrated by forces far more sophisticated than the average participant can comprehend. To truly profit, one must learn to look beyond the deceptive surface, to quiet the internal noise, and to develop an acute sensitivity to the subtle, almost imperceptible shifts that betray its true intentions. These vital clues, these hidden signals, are not found in the morning newspapers or in the breathless pronouncements of financial pundits. They are embedded within the very core of the market's own actions, in the precise choreography of price movements, in the ebbs and flows of trading volume, and in the unspoken messages exchanged between the powerful forces that truly command its immense energy. This is the realm of the speculator, a domain built upon observation, not speculation. The market is a living, breathing entity, constantly communicating its intentions, its strengths, and its weaknesses, but it speaks in a language few truly understand. It whispers of impending shifts long before they become shouts, offers subtle hints of accumulation or distribution long before the public is aware of a change in fundamental conditions. Those who fail to learn this language are doomed to react, perpetually late, perpetually chasing opportunities that have already been seized by others. To transcend the level of the mere speculator and ascend to the ranks of the truly masterful, you must shed the comforting illusion of superficial understanding. You must cultivate an unyielding commitment to looking deeper, to listening more acutely, and to discerning the unseen forces at play. This journey into the market's hidden signals is challenging, but it is the absolute prerequisite for transforming mere hope into consistent, disciplined, and formidable success. The market, my friends, possesses its own intricate, powerful, and often unseen language. It communicates its intentions not through eloquent speeches or declarative statements, but through a constant, dynamic interplay of its most fundamental elements, price and volume. These are the hieroglyphs of speculation, the raw, unfiltered data points that, when properly interpreted, narrate the market's own story, revealing its strengths, its weaknesses, and its impending moves long before external events catch up. Most participants spend their time consumed by the noise of the financial world, the breaking news, the endless reports, the economic forecasts, the endless opinions. They believe these external narratives drive prices. But I tell you, with the certainty born of immense profits and devastating losses, that these external factors are merely the explanation for moves that have already begun, or are well underway. The true narrative, the decisive signals, are always found within the cold, objective action of the market itself. Consider the price. It is the direct reflection of the momentary battle between buyers and sellers. Every tick, every fluctuation, every trend line, every consolidation pattern, these are not random occurrences. They are the visible manifestation of underlying forces, of accumulation by the powerful or distribution by those preparing to exit. The market, through its price, is constantly drawing a map of its immediate intentions, for those with the discipline to observe. Volume, on the other hand, is the truth-teller, the measure of conviction behind the price's movements. A significant price move unaccompanied by robust volume is often suspect, a mere illusion, lacking the true force to sustain itself. But a price surge on increasing volume, or a price decline on heavy volume, These are unequivocal declarations. Volume confirms the narrative that price begins to tell, indicating whether real demand or supply is present. To master this unseen language, one must cultivate a profound detachment, stripping away all personal bias, all hope, all fear, and all reliance on external chatter. The market's story is told dispassionately, devoid of emotion, and it rewards only those who can read it with the same objective clarity. This is the difference between guessing and knowing, between gambling and intelligent speculation. Therefore, your focus must shift entirely. Abandon the endless pursuit of external explanations. Instead, immerse yourself in the pure, unadulterated action of price and volume. Learn to see the subtle shifts, the emerging patterns, the unspoken commands. For within this unseen language lies the true power to anticipate, to react, and ultimately, to profit from the market's every significant move. The ability to discern the market's hidden signals is not an innate talent, nor is it bestowed by chance. It is a skill meticulously cultivated through the discipline of obsessive observation. This demands a commitment that transcends casual interest, requiring countless hours of focused, unwavering study of the market's movements, without distraction, without preconceived notions, and without the impulse to prematurely act. This is the true apprenticeship of the speculator. In my early years, before I ever commanded substantial capital, I spent endless hours in the bucket shops, my gaze fixed upon the ticker tape. I watched every fluctuation, noted every volume surge, observed every shift, not to predict, but to understand. This was my university, my laboratory, where I meticulously absorbed the market's raw data, discerning patterns and rhythms that were invisible to those who sought only to gamble or to chase fleeting tips. This obsessive observation is a profound mental exercise. It requires silencing the internal chatter of ego and desire, and suppressing the emotional impulses that compel premature action. You must train your eye to see what is, not what you wish to be, to discern objective fact from subjective hope. This level of detachment and focus is not easily achieved. It demands relentless self-discipline and an unyielding commitment to the truth of the tape. The hours spent in this silent study may seem unproductive to the uninitiated, who equate activity with progress, but I assure you, these are the most valuable hours a speculator can invest. It is during these periods of meticulous observation that the mind begins to absorb the market's subtle nuances, to recognize the formation of significant patterns, and to develop an almost intuitive understanding of its underlying forces. This profound commitment to observation builds an invaluable internal library of market behavior. You begin to recognize the characteristic footprints of accumulation before a major upward move, or the telltale signs of distribution preceding a sharp decline. These are not intellectual deductions alone. They become ingrained instincts, refined by the sheer volume of disciplined study, allowing you to react with precision when the true signals finally emerge. Ultimately, cultivating the eye of the speculator is an arduous, solitary journey. It demands immense patience, an unyielding dedication to truth, and the ruthless suppression of impulsive behavior. But it is precisely this discipline of obsessive observation that unlocks the market's hidden language, transforming chaos into clarity, and turning mere hope into a formidable, consistent edge. A pervasive and utterly destructive fallacy that traps most market participants is the belief that external events or news fundamentally drive prices. They spend their hours poring over economic reports, dissecting corporate announcements, and analyzing geopolitical developments, convinced that understanding these narratives will reveal the market's next move. Yet, I tell you, with the certainty born of immense experience, that this is a fundamental misunderstanding of the market's true nature. News and events are merely the explanations that often accompany or follow price movements. They rarely cause the significant shifts. The powerful forces that truly command the market, the large operators, the informed money, often begin their accumulation or distribution long before the news becomes public. By the time the event is widely known and its implications are being debated, the decisive move has often already occurred, and the smart money is either well positioned or already taking profits. To react to news is to be perpetually late, to chase a train that has already left the station. The market is not waiting for a newspaper headline to decide its direction. Its movements are dictated by the relentless interplay of supply and demand, orchestrated by those with foresight, deep pockets, and a keen understanding of underlying conditions that are not yet public knowledge. The news merely provides a convenient narrative to rationalize moves that have already transpired on the tape. Consider how often a major news announcement, seemingly bullish or bearish, is immediately followed by a counterintuitive price movement. The good news is met with selling, or bad news with buying. This occurs because the smart money, having already discounted the event or possessing a deeper understanding of its true implications, is acting on information that precedes the public narrative. The market discounts, it does not react blindly. Therefore, spending your precious time dissecting news reports is largely a futile exercise in hindsight. It distracts you from the only true source of actionable intelligence, the objective behavior of the market itself. The market always reveals its intentions through its own actions, in the price and volume, long before those intentions are rationalized by external events. To truly spot imminent moves, you must abandon the comfort of external explanations and instead, immerse yourself in the raw, unfiltered truth of the tape. The market speaks its own language, and it rewards those who listen to its subtle commands, rather than waiting for its actions to be validated or explained by the very events they ostensibly create. The price is the reality. The news is often merely its echo. The market's most significant moves, the ones that generate colossal fortunes, are rarely accidental or spontaneous. They are the deliberate outcome of strategic actions by large, sophisticated operators, the big money. These powerful entities, with their vast capital and keen foresight, leave behind discernible traces, subtle footprints of accumulation and distribution, which, if properly interpreted, betray their intentions long before the market's explosive moves become apparent to the average speculator. Accumulation is the meticulous process by which large operators quietly acquire significant positions in a stock they believe is poised for a substantial upward move. This cannot be done in a single, obvious transaction, as it would immediately drive up the price. Instead, they patiently and systematically buy shares over an extended period, often during periods of weakness or consolidation, ensuring their purchases are absorbed by the market without signaling their intent. These footprints may manifest as subtle upward drifts on higher volume, or a stock's refusal to fall on bad news. Conversely, distribution is the equally deliberate process by which these same large operators meticulously unload their positions in a stock they believe is about to experience a significant decline. Just as they cannot buy all at once, they cannot sell all at once without crashing the price. Therefore, they patiently and systematically sell shares over an extended period, often during periods of strength or market euphoria, ensuring their sales are absorbed without signaling their intention to exit. These footprints may appear as a stock's inability to rally on good news, or increasing volume on static prices. Learning to identify these subtle footprints requires a profound understanding of price and volume dynamics. It demands an eye for patterns that deviate from the norm, a sensitivity to changes in the stock's character, and the ability to differentiate genuine, underlying buying or selling pressure from mere speculative noise. This discernment allows the astute observer to position themselves with the big money, rather than being swept away by its eventual, decisive moves. The market, in its wisdom, always gives subtle clues. These footprints are the unspoken conversations between the powerful forces, betraying their strategic positioning long before their intentions are formalized by public news or analyst recommendations. By recognizing these patterns of accumulation and distribution, the speculator gains an invaluable edge, understanding the market's true intentions before they become apparent to the general public. Ultimately, mastering the art of discerning these footprints of big money is a cornerstone of intelligent speculation. It allows you to anticipate the major shifts, to understand the true underlying sentiment of the powerful forces at play, and to align your own actions with the very movements that generate the most substantial profits, transforming mere hope into disciplined, confirmed conviction. While price paints the picture of a market's movement, volume serves as the ultimate truth-teller, the indispensable factor that confirms or repudiates the narrative hinted at by price action alone. A significant price move, whether upwards or downwards, if unaccompanied by robust and sustained trading volume, is often a deceptive illusion, a mere ripple on the surface lacking the true underlying force to sustain itself. Volume reveals the genuine conviction, or lack thereof, behind every shift. High volume accompanying a price surge signifies genuine accumulation, indicating that large, interested capital is actively entering the market, eager to acquire shares even at higher prices. This validates the upward move, confirming that demand is truly outweighing supply and that the momentum is likely to continue. Conversely, a price decline on heavy volume indicates determined distribution, signaling that powerful interests are actively unloading their positions, confirming that supply is overwhelming demand and further downward movement is likely. Conversely, a price move on low volume is often a warning sign, a shakeout or a test of the market, but not a true declaration. A stock might drift higher on thin volume, giving the impression of strength, but this merely indicates an absence of selling pressure, not a true buying frenzy. Such moves are susceptible to swift reversals, as little capital is required to either push them up or pull them down. The lack of participation reveals a lack of conviction. Learning to accurately interpret the interplay between price and volume is a cornerstone of spotting hidden signals. It requires a keen eye for discrepancies. A stock breaking to new highs on diminishing volume, for example, might suggest exhaustion in buying pressure and an impending reversal, despite the seemingly bullish price action. Volume, in such cases, whispers a truth that price tries to conceal. This meticulous analysis of volume transcends mere numerical figures. It's about understanding the quality of the participation. Is the volume consistent with the move? Is it increasing on advances and decreasing on reactions, in an uptrend, or vice versa, in a downtrend? This nuanced reading allows the speculator to discern genuine, underlying buying or selling pressure from mere speculative noise, confirming the true strength or weakness of a market's move. Ultimately, volume is the market's stamp of authenticity. It is the raw, unfiltered evidence that validates price action, confirming the presence of true demand or supply forces beneath the surface. To miss the message of volume is to trade blindly, to rely on incomplete information, and to perpetually misinterpret the market's true intentions, leaving one vulnerable to the subtle deceptions that precede significant price shifts. The market, in its perpetual dance between buyers and sellers, often establishes key levels of support and resistance, invisible boundaries that, when tested or violated, broadcast powerful signals of imminent moves. Support represents a price level where buying interest is strong enough to halt a decline, acting as a floor. Resistance signifies a price level where selling pressure is sufficient to cap a rally, serving as a ceiling. These are not arbitrary lines. They represent zones where market consensus on value has temporarily coalesced. Understanding these key levels is paramount for any speculator seeking to discern the market's true intentions. When a stock approaches a previously established support level, its behavior at that point is critical. Does it bounce decisively, confirming the demand? Or does it hesitate, showing weakness, hinting at an impending break lower? The interaction of price with these levels often determines the next major directional movement, revealing the balance of power between buyers and sellers. A breakout occurs when a stock decisively moves beyond a well-defined resistance level on strong volume, signaling that buying pressure has finally overwhelmed supply. This is a powerful signal of an imminent upward move, as the stock has overcome a significant barrier and is now on a path of potentially least resistance higher. Conversely, a break below a significant support level, particularly on heavy volume, indicates that selling pressure has overwhelmed demand, signaling an imminent downward move. These breakouts are not always genuine. The market is replete with false breakouts or head fakes designed to trap eager, impatient speculators. Therefore, confirming the legitimacy of a breakout is crucial. It requires observing the subsequent price action. Does the stock hold its new ground? Does volume confirm the initial thrust? A false breakout, where price quickly retreats back into its previous range, often signals that the true move will be in the opposite direction, trapping those who acted prematurely. Mastering the identification and interpretation of these key levels provides the speculator with a profound advantage. It offers clear entry points, defines risk parameters, and, most importantly, reveals the market's underlying intentions. Observing a stock consolidate below a resistance level, then decisively punch through it on significant volume, is the market's clear declaration of intent, a powerful signal that an imminent, substantial move is underway. Ultimately, key levels of support and resistance are the market's silent pronouncements, marking psychological battlegrounds where the forces of supply and demand clash. Learning to read these zones, understanding the significance of their tests and their eventual breaches, equips the speculator with a precise roadmap for identifying imminent moves and positioning themselves for maximum advantage. Contrary to the common misconception that active, volatile markets offer the best opportunities, the astute speculator understands that the most profound profits are often forged during the quiet periods of consolidation. These are phases of low volatility and seemingly aimless sideways movement, where a stock's price remains confined within a relatively narrow range. While these periods may appear dull and uninteresting to the impatient eye, they are, in fact, crucial preparatory stages for explosive, imminent moves. Imagine a spring being slowly, meticulously coiled. The energy is not immediately apparent. The movement is subtle, contained. Yet, the tighter the coil, the greater the potential for a powerful release. Similarly, consolidation periods are where market forces, accumulation by large operators or quiet distribution, are silently building. During these phases, supply and demand come into a temporary, uneasy equilibrium, absorbing previous price movements and laying the groundwork for the next major trend. For the impatient or the untrained observer, these quiet periods are a source of frustration. They offer no immediate thrill, no rapid gains, and often lead to boredom or impulsive, ill-timed trades that result in minor losses. Such individuals seek constant action, failing to recognize that true preparation, the kind that precedes significant profits, often involves periods of profound strategic inaction and diligent observation, awaiting the moment of decisive market declaration. Learning to discern the true nature of consolidation is critical. Not all sideways movements are significant. Some are merely periods of disinterest. However, observing a stock's consistent refusal to fall below a certain level despite market weakness, or its repeated testing of an upper boundary, even on seemingly low volume, can be a telltale sign of intelligent money quietly accumulating positions, absorbing all available supply without driving up the price prematurely. The longer and tighter the consolidation pattern, the greater the potential energy being built up, and the more explosive the subsequent move is likely to be. These are periods where the market is silently gathering its strength, accumulating pressure beneath the surface. The moment the stock finally breaks out of this confined range, particularly on strong and decisive volume, it signals a release of this pent-up energy, indicating an imminent and often powerful directional movement. Ultimately, the quiet periods of consolidation are the market's silent preparation. They offer the disciplined speculator an invaluable opportunity to observe, to accumulate patiently, or distribute, and to position themselves strategically before the explosion. Missing the message of these seemingly dull phases is to miss the very genesis of the market's most significant and profitable moves, leaving one perpetually reacting to events rather than anticipating them. While the general market trend is paramount, an astute speculator must possess the keen eye to identify crucial divergences of strength, particularly when certain stocks or sectors display an extraordinary resilience or even an upward trajectory during periods of general market weakness. These leading stocks often provide early, subtle signals of an impending shift in the broader market's character, acting as harbingers of a potential turnaround. They are the first rays of light in a seemingly darkening sky. When the general market is experiencing a significant decline, or languishing in a protracted bearish phase, most stocks will naturally follow the prevailing tide. However, observing a specific stock or a particular sector that either refuses to fall significantly, or, more remarkably, actually begins to show signs of accumulation and even starts to rally against the pervasive negativity, is a critical signal. This defiance indicates strong underlying buying interest, a hidden demand that is absorbing all selling pressure. This divergence suggests that informed money, or a powerful new force, sees value in these specific securities despite the prevailing pessimism. They are accumulating positions, often quietly, recognizing a fundamental shift that the broader market has yet to acknowledge. This deliberate buying acts as a countercurrent, preventing the stock from succumbing to the general downward pressure, and positioning it for an explosive move once the broader market finally bottoms out and begins its own recovery. Conversely, a divergence can also manifest as a leading weakness. In a generally bullish market, if a particular stock or sector begins to lag significantly, shows signs of distribution, or even starts to decline while everything else is moving higher, it can signal an impending top for that specific security, or even serve as an early warning of a broader market weakness that is yet to unfold. These are the first cracks in the facade of strength. Learning to spot these subtle but powerful divergences requires continuous, meticulous observation and a profound understanding of comparative strength. It demands looking beyond the obvious headline makers and diligently studying the relative performance of individual stocks and sectors against the backdrop of the overall market. This comparative analysis is a cornerstone of intelligent speculation, allowing one to identify potential leaders or laggards before their true intentions become widely apparent. Ultimately, the divergence of strength provides the speculator with an invaluable early warning system. By discerning which stocks defy or anticipate the broader market's movements, one gains a significant edge, positioning themselves not just to follow the trend, but to potentially identify its very inception. This keen observational skill is crucial for spotting imminent moves, ensuring the speculator is ahead of the curve, prepared for the market's next significant declaration. The market, in its ceaseless dance, often employs elaborate deceptions designed to trap the unwary, the impatient, and the emotionally driven. Among the most potent of these traps are failed breakouts and false moves, deceptive surges or declines that appear to signal a clear direction, only to reverse abruptly, catching unsuspecting speculators on the wrong side. Recognizing these warning signs is absolutely critical for preserving capital and for discerning the market's true, often counterintuitive, intentions. A failed breakout occurs when a stock decisively moves beyond a well-defined resistance level, or below a support level, appearing to signal a strong continuation of the trend, only to quickly reverse direction and retreat back into its previous trading range. This initial move often draws in eager buyers, or sellers, who act on the apparent signal, only to find themselves immediately trapped as the price moves against them, suffering quick and painful losses. The insidious nature of a false move lies in its ability to generate conviction, compelling participation based on what appears to be an undeniable market signal. It exploits the human tendency to chase obvious movements, capitalizing on the fear of missing out. The initial thrust seems powerful, attracting liquidity, but the swift reversal reveals its true purpose: to lure speculators into unfavorable positions before the real, often opposite, move begins. Learning to distinguish a genuine breakout from a false one requires meticulous observation and a profound understanding of confirmation. A genuine breakout will typically be accompanied by robust and sustained volume, and the price will hold its new ground, often retesting the broken level from above or below, and then continuing in the direction of the breakout. A false move, however, often lacks this confirming volume and quickly fails to hold, indicating a lack of underlying conviction. The reversal after a failed breakout is often a powerful signal of the true direction the market intends to take. Those who were lured in by the false move are now trapped, compelled to liquidate their positions as the price moves against them, thereby fueling the genuine move in the opposite direction. Recognizing this head fake allows the astute speculator to not only avoid significant losses, but to potentially position themselves for a profitable move in the very direction that others are being forced to flee. Ultimately, failed breakouts and false moves are the market's subtle, yet potent, warnings. They represent deliberate traps set by the sophisticated forces to capitalize on the impulsiveness of the crowd. By cultivating the discipline to meticulously confirm all breakouts, to recognize the characteristic signs of a false move, and to act decisively when such deceptions are revealed, the speculator transforms potential pitfalls into invaluable opportunities, preserving capital and gaining a powerful edge. The market, much like a living entity, possesses a distinct personality, a characteristic rhythm or behavior that defines its movements over time. An astute speculator must cultivate an acute sensitivity to the subtle change of character in a stock's price behavior, for these shifts often serve as early, crucial signals of an impending major move or a significant reversal. This is about discerning when the market's familiar tune begins to play a different, ominous melody. Every stock, every commodity, every market tends to move in a particular fashion during specific phases. During an uptrend, it might exhibit strong rallies followed by shallow, orderly corrections. In a downtrend, it might drop sharply, then rebound weakly. When this established pattern suddenly and inexplicably alters, for instance, if a stock in a strong uptrend begins to experience deeper corrections, struggles to make new highs, or shows unexpected weakness on good news, it is a potent warning, a change of character signal. This subtle alteration of a stock's typical rhythm indicates that underlying forces are shifting. The dominant buyers or sellers, who previously controlled its direction, might be losing their conviction, or new, powerful players might be entering the arena with opposing intentions. The market is subtly communicating that the path of least resistance, which once seemed so clear, is beginning to waver, and a new phase, potentially a reversal, is imminent. Learning to discern these shifts requires meticulous, continuous observation, comparing current behavior to established patterns. It demands an eye for deviations from the norm. A stock that previously rebounded sharply from support now lingers there, showing indecision. A rally that once occurred on strong volume now struggles on thin participation. A consolidation that typically resolved upwards now appears heavy and ready to break down. These are not isolated incidents. They are components of a new, emerging narrative. The effectiveness of recognizing these changes of character lies in their subtle nature, often preceding obvious trend reversals or major news events. They are the market's whispers before its shouts, providing the disciplined speculator with an invaluable early warning system. By detecting these shifts, one can adjust their positions, prepare for a reversal, or even initiate new trades before the broader market becomes aware of the changing tide. Ultimately, cultivating an acute sensitivity to a stock's change of character is a hallmark of true market mastery. It transforms the speculator from a mere follower of established trends into a discerning observer capable of anticipating their very inception or dramatic conclusion, positioning themselves for maximum advantage in the face of imminent and significant shifts. In the intricate battle between buying and selling forces, one of the most powerful and often overlooked signals of an impending upward move is the market's ability to absorb significant selling pressure without declining. This is the test of supply, where large blocks of stock are offered for sale, yet the price holds firm, or even moves higher. It is a clear indication that a powerful, underlying demand is present, quietly absorbing all available shares, thereby revealing the market's true, hidden strength. This phenomenon typically occurs during periods of consolidation or after a stock has experienced a previous decline. Weak holders, impatient speculators, or those forced to sell by external circumstances, unload their shares. If the price does not break down significantly under this selling pressure, it means that equally powerful or stronger buying interests are systematically entering the market, eager to accumulate those shares without driving the price upwards prematurely. This absorption is a silent declaration of intent. The market's ability to withstand and absorb heavy selling without succumbing reveals a profound underlying demand. It signifies that the remaining supply is being meticulously cleared out, absorbed by strong hands who believe the stock is undervalued or poised for a significant move. This process often cleanses the market of weak players, leaving the field clear for an impending upward thrust as the supply-demand balance fundamentally shifts. Observing the test of supply requires a keen eye for the interplay of price and volume. A stock might experience periods of increased volume on minor price declines, or even remain stagnant, then rebound quickly. This suggests that every time a seller steps in, a buyer is immediately present to absorb the shares, preventing a price collapse. The absence of a sustained price drop despite visible selling activity is the critical clue, revealing the presence of a powerful, underlying accumulation. The more significant the selling pressure that is absorbed without a substantial price decline, the more powerful the subsequent upward move is likely to be. This signal often precedes major breakouts from consolidation patterns, as the big money, having meticulously cleared out the available supply, is now ready to allow the price to run freely. The market has effectively digested all the sellers, and the path of least resistance has shifted unequivocally upwards. Ultimately, understanding and recognizing the test of supply is a hallmark of advanced market observation. It allows the disciplined speculator to discern genuine underlying demand, to position themselves before the inevitable upward move, and to profit immensely from the market's hidden strength. This signal is a clear indication that a stock is being prepared for an imminent and significant advance, revealing the true intentions of the powerful forces at play. In the vast, often chaotic sea of market movements, the disciplined speculator must possess the unwavering focus to await the unmistakable signal, the point of least resistance. This is the culmination of myriad smaller observations, the moment when all the subtle cues, accumulation, volume confirmation, key level breaches, changes of character, converge to reveal an undeniable clarity, a definitive direction in which the market is most likely to move with the greatest ease and force. This is where the speculator commits. This point is not a prediction. It is an objective recognition of the market's own declaration. It is the moment when the forces of supply and demand have shifted so decisively that the path for a significant price movement is unequivocally clear. All major obstacles have been overcome. All selling pressure has been absorbed, in an uptrend, or all buying support has collapsed, in a downtrend, leaving the path open for a powerful, unhindered surge. For the impatient, this point is often missed. They act prematurely, chasing fleeting impulses or unsubstantiated rumors, only to find themselves caught in whipsaws or trapped in false moves. The discipline lies in the waiting, in resisting the urge to act until the market itself provides the absolute, undeniable confirmation that the path of least resistance has been firmly established, and the momentum is ready to be harnessed. The unmistakable signal is typically characterized by a decisive breakout from a well-defined consolidation pattern, occurring on strong and expanding volume. This is the market announcing its intentions loudly and clearly. It is the release of pent-up energy, the breaking of a significant barrier, and the undeniable confirmation that a new, powerful phase of movement has begun, inviting the astute speculator to join its inevitable flow. This signal is not subject to interpretation or debate. It is an objective fact revealed by the market's own behavior. It allows the speculator to enter a trade with profound conviction, knowing that they are aligning themselves with the dominant forces, riding the crest of the wave rather than battling against the tide. The risk, though always present, is clearly defined, and the potential for profit is amplified by the sheer force of the market's declared direction. Ultimately, mastering the identification of the point of least resistance is the cornerstone of intelligent speculation. It transforms trading from a game of chance into a disciplined pursuit of probability. By meticulously awaiting this unmistakable signal, the speculator ensures their actions are always aligned with the market's true power, positioning them for substantial and consistent gains derived directly from the market's own unfolding story. Knowing when the market has provided its unmistakable signal is one thing. Possessing the unwavering discipline and courage to act on that confirmation with decisive action is another entirely. This is the critical juncture where opportunity translates into profit, where observation transforms into execution. For the astute speculator, hesitation in the face of clear confirmation is as detrimental as acting prematurely on unverified hunches. This is where the psychological battle is won or lost. The market, in its ceaseless motion, presents windows of opportunity that are often fleeting. When all the subtle signals converge, when the point of least resistance is unequivocally declared, the moment for action arrives swiftly. Procrastination, further analysis paralysis, or seeking additional external validation will inevitably lead to missed opportunities, forcing one to chase a move that has already gained significant momentum, or worse, to enter at an unfavorable price. Decisive action, in this context, is not impulsive. It is the culmination of disciplined observation and meticulous preparation. It means having a predefined plan for entry once the confirmation is received, and executing that plan without hesitation or emotional interference. The conviction born of the market's own undeniable signal empowers the speculator to act with speed and confidence, knowing their move is aligned with objective truth, not personal bias. The contrast between those who act decisively on confirmation and those who falter is stark. The indecisive are perpetually relegated to reacting to events, forever chasing the market, often entering near the end of a move or getting caught in reversals. The decisive, however, are able to position themselves early, ride the bulk of the trend, and capitalize fully on the market's declared intentions. Their precision is a direct result of their discipline. This principle extends beyond mere entry. It applies equally to exits. Once the market signals a change in trend or a loss of momentum, decisive action to take profits or cut losses is paramount. Lingering out of hope or fear after the market has delivered its new verdict is a common pitfall. Acting swiftly on confirmation, whether for entry or exit, protects capital and maximizes profit potential. Ultimately, acting on confirmation is the distinguishing mark of a professional speculator. It transforms the vast, chaotic market into a realm of predictable opportunities for those willing to wait for the clear signal and then execute with unwavering resolve. This disciplined decision-making, rooted in the market's own truth, provides the ultimate edge in capturing imminent and significant moves. Even with meticulous observation, the market's true intentions can, at times, retain a subtle ambiguity. For such situations, the disciplined speculator employs a crucial tactic: the first probe, a small, initial position designed specifically to test the market's true intent before committing substantial capital. This is not a speculative bet. It is a meticulously calculated experiment, a minimal commitment made to elicit immediate and unequivocal feedback directly from the market itself. The purpose of this initial probe is to ask the market a direct question: is my analysis truly correct? Is the path of least resistance genuinely established in this direction? By initiating a limited exposure, the speculator seeks to observe the market's immediate, unfiltered reaction. Does the price instantly move in the desired direction, even if by a small margin? Does it hesitate, indicating resistance? Or does it unequivocally move against the initial position, signaling a fundamental misjudgment? If the market responds positively, moving in the desired direction, it provides invaluable, tangible confirmation. This validates the underlying analysis and indicates that the larger move is indeed ready to unfold. The successful probe serves as the green light, signaling that the speculator can then, with confidence and increased capital, systematically add to the winning position, leveraging the confirmed momentum for greater profits. Conversely, if the initial probe is met with immediate resistance, or, worse, moves decisively against the position, it provides equally invaluable feedback. The analysis was flawed, the timing was off, or the market's true intention lies elsewhere. In such cases, the discipline is to exit the probe immediately, taking a negligible, controlled loss. This swift, decisive action protects capital and prevents a small error from escalating into a significant defeat. This strategy of testing the market with a first probe minimizes risk while maximizing learning. It prevents the speculator from committing heavily to a thesis that the market has not yet validated, preserving precious capital for truly confirmed opportunities. It teaches humility, objectivity, and the paramount importance of allowing the market to be the ultimate arbiter of truth, rather than relying solely on personal conviction. Ultimately, employing the first probe is a hallmark of intelligent, defensive speculation. It transforms uncertainty into clarity, turning potential large losses into insignificant tuition fees. By meticulously testing the market's intent before full commitment, the speculator gains a profound advantage, ensuring that their capital is deployed only when the market itself has unequivocally confirmed its hidden signals and its imminent, profitable direction. Among the gravest errors that consistently trap speculators, leading to missed opportunities and unnecessary losses, is the obsessive focus on price alone, at the expense of impeccable timing. Many spend countless hours haggling over fractions of a dollar, convinced that squeezing out an extra eighth or quarter point on their entry or exit will make all the difference. Yet, I assure you, from the depths of my own hard-won experience, a perfectly timed entry, even if it means paying a slightly higher price, is infinitely superior to a poorly timed entry, no matter how cheap the price might seem. The market does not care about your desire for a bargain. It rewards precision and alignment with its dominant forces. A stock that appears cheap or on sale is often cheap for a very good reason. It is moving against the path of least resistance, indicating underlying weakness. To attempt to acquire it at the lowest possible price, before the market itself has unequivocally declared its intention to move higher, is often an exercise in futility, akin to trying to catch a falling knife. Such bargain hunting invariably leads to significant losses, as cheap very quickly becomes cheaper. Conversely, waiting for the ideal moment, the precise confluence of factors that signals an imminent, high-probability move, is a far more valuable commodity than the pursuit of a theoretical perfect price. This discipline allows the speculator to position themselves just as the market is preparing for its significant surge, ensuring they ride the bulk of the move rather than being early and trapped, or late and merely chasing. The slight difference in entry price will be negligible compared to the potential gains captured by being in perfect sync with the market's true momentum. Consider the scenario. You identify a stock that fundamentally appears undervalued. You then wait, and wait, and wait, fixated on acquiring it at the absolute lowest price. Meanwhile, the market begins to confirm your thesis. The stock starts its inevitable upward movement, and you miss the initial, powerful thrust because your attention was consumed by a few insignificant pennies. This preoccupation with price minutiae blinds you to the grander, far more profitable picture of the market's unfolding intentions. The market, in its wisdom, communicates its readiness for a significant move through its actions, through decisive breakouts, confirming volume, and the clear establishment of its path of least resistance. When that unmistakable signal is finally delivered, when all the forces align, the moment for action arrives swiftly and demands unwavering resolve. Hesitation, fueled by the desire for a better price, will inevitably lead to missed opportunities, forcing one to enter at a less favorable position, or worse, to miss the move entirely. Ultimately, cultivating an unwavering focus on the perfect timing, rather than succumbing to the tyranny of the perfect price, is a hallmark of the masterful speculator. It is the distinction between gambling and intelligent speculation. By diligently observing the market, allowing it to speak its truth, and striking decisively when the opportune moment arrives, you transform potential into profit, ensuring your actions are always aligned with the irresistible power of the market's imminent and significant moves. The market, in its ceaseless, almost cyclical nature, periodically enters phases of extreme emotional intensity, the chilling depths of panics and the intoxicating euphoria of booms. While these periods appear chaotic and unpredictable to the uninitiated, they are, in fact, governed by universal psychological and behavioral signals that, when properly understood, serve as critical harbingers of imminent major reversals. To the disciplined observer, even in the loudest clamor, the market speaks its truth. During a panic, the market is gripped by pervasive fear, despair, and indiscriminate selling. Prices plummet, often far below any rational valuation, as weak holders capitulate and even strong players are forced to liquidate positions. This environment is characterized by overwhelming negative sentiment, widespread pessimism, and a seemingly endless stream of bad news. The common perception is that the world is ending, and prices can only go lower. However, beneath this surface of chaos, the astute observer can discern powerful, universal signals of an impending bottom. These may include a climactic selling climax on massive, exhaustive volume, a sudden sharp reversal that absorbs immense selling pressure, or a period where prices simply refuse to fall further despite continued bad news. These are the whispers of accumulation by strong, informed hands, patiently buying into the despair, knowing that the fear has reached its peak and a rebound is imminent. Conversely, during a boom, the market is characterized by irrational exuberance, widespread optimism, and a relentless pursuit of ever higher prices, often fueled by speculation rather than fundamental value. Greed becomes the dominant emotion, driving prices to unsustainable levels, as every participant believes they are a genius and the upward trend will never end. Rationality is systematically supplanted by intoxicating euphoria and a pervasive disregard for risk. Yet, even in the loudest celebrations, the market subtly broadcasts its warning signals of an impending top. These may include a climactic buying climax on massive, exhaustive volume, a stock's failure to make new highs despite overwhelming positive sentiment, or a period of intense distribution by smart money, hidden within seemingly strong rallies. These are the market's subtle announcements that the upward surge has exhausted itself, and a significant correction or reversal is imminent. Ultimately, the panics and booms are the market's extreme emotional expressions, but they are also its loudest, albeit often ignored, universal signals of impending major reversals. By cultivating the discipline to observe these periods with cold objectivity, to look beyond the dominant emotional narrative, and to discern the underlying behavioral patterns of accumulation or distribution, the speculator gains an invaluable edge, positioning themselves for immense profit from the market's most significant and dramatic turning points. A profound and utterly pervasive fallacy that traps the vast majority of market participants is the relentless obsession with the news cycle. They spend countless hours poring over economic reports, dissecting corporate announcements, analyzing geopolitical developments, and absorbing every public utterance from influential figures, convinced that understanding these external narratives will unfailingly reveal the market's next move. Yet, I tell you, with the certainty born of immense profits and devastating losses, that this is a fundamental misunderstanding of the market's true nature. It is not driven by news, but by the actions of informed capital. News and external events are almost invariably the explanations that accompany or follow price movements, they rarely, if ever, cause the significant shifts that generate substantial wealth. The powerful forces that truly command the market, the large, sophisticated operators who move millions, often begin their meticulous accumulation or distribution of positions long before the news becomes public knowledge. By the time the event is widely known, its implications debated, and its narrative sensationalized, the decisive price movement has often already occurred, and the smart money is either well-positioned or already discreetly taking profits. To react to news is to be perpetually relegated to the position of a follower, perpetually late, forever chasing a train that has already departed the station. The market does not wait for a newspaper headline to decide its direction. It discounts future developments, reacting to the foresight of informed capital. Its movements are dictated by the relentless interplay of underlying supply and demand, orchestrated by those with keen foresight, immense financial power, and a deep understanding of evolving conditions that are not yet part of the public narrative. The news merely provides a convenient, often misleading, narrative to rationalize moves that have already transpired on the tape. Consider the perplexing frequency with which a seemingly monumental news announcement, unequivocally bullish or bearish, is immediately followed by a counterintuitive price movement. Good news is met with determined selling, or bad news with vigorous buying. This occurs precisely because the smart money, having already discounted the event, or possessing a deeper, more accurate understanding of its true implications, is acting on information that fundamentally precedes the public narrative. The market discounts future realities. It does not react blindly or impulsively to headlines. Therefore, spending your precious time and mental energy dissecting news reports, listening to punditry, or chasing every rumor is largely a futile and counterproductive exercise in hindsight. It serves only to distract you from the only true and actionable source of intelligence, the objective, unfiltered behavior of the market itself. The market always reveals its genuine intentions through its own precise actions, in the raw, unbiased data of price and volume, long before those intentions are rationalized or explained by external events. Ultimately, to truly spot imminent moves and to gain an insurmountable edge, you must cultivate the discipline to consciously disregard the endless noise of the news cycle. Abandon the comfort of external explanations and instead, immerse yourself in the pure, unadulterated truth of the tape. The market speaks its own language, revealing its intentions directly, and it rewards those who listen to its subtle, unspoken commands, rather than waiting for its actions to be validated or explained by the very events they ostensibly create. The price is the ultimate reality. The news is often merely its manipulative echo. The market, in its relentless efficiency, tolerates neither arrogance nor illiteracy. For those who enter its arena without having meticulously learned its language, without understanding its fundamental laws, and without the discipline to heed its subtle warnings, the path is almost inevitably one of devastating losses and ultimate ruin. This is the cost of ignorance, a brutal tuition exacted from those who choose blindness over enlightenment, and impulse over calculated strategy. To remain ignorant of the market's hidden signals, to fail to discern its true intentions beyond the superficial clamor of news and opinions, is to operate in a perpetual state of profound vulnerability. Such individuals are constantly reacting to events that have already transpired, chasing opportunities that have already been seized by others, and perpetually falling prey to the deliberate deceptions orchestrated by more sophisticated forces. Their actions are driven by hope, by fear, and by unverified hearsay, rather than by objective truth. The market, with its cold, unfeeling logic, quickly punishes those who refuse to learn its rules. A speculator who cannot distinguish between genuine accumulation and manipulative distribution, who cannot read the true message of volume, or who fails to recognize the significance of key price levels, is akin to a blindfolded gambler. Their actions are based on chance, their entries are often ill-timed, and their exits are often forced by escalating losses. This ignorance breeds a cycle of repeated errors. Without a clear understanding of why trades fail, the undisciplined speculator is doomed to repeat the same mistakes, perpetually reinforcing their own downfall. Each loss, instead of being a valuable lesson, becomes merely another step towards inevitable financial ruin, further eroding capital and confidence. The market does not forgive those who refuse to invest in their own education. Furthermore, ignorance of the market's true signals leaves one utterly susceptible to the deliberate traps set by experienced operators. False breakouts, manufactured news events, and orchestrated price manipulations are specifically designed to capitalize on the blindness of the uninformed. Those who cannot discern the underlying intent are easily lured into unfavorable positions, only to see their capital swiftly confiscated by the very forces they fail to comprehend. Ultimately, the cost of ignorance in the market is not just missed profits, it is the inevitable and total destruction of capital. For the true nature of speculation demands rigorous study, unwavering discipline, and an unyielding commitment to objective observation. Those who refuse to pay this price, who prefer blindness to the illuminating, yet often stark, truth of the market, are destined to serve as mere fodder for those who have mastered its hidden language and heeded its profound warnings. My friends, the journey into the market's hidden signals is arduous, demanding relentless study and unwavering self-discipline. Yet, the profound reward for cultivating this keen observational skill is the development of your own personal market compass, an almost intuitive understanding of the market's underlying forces, a finely tuned instinct for discerning imminent moves, even before they become apparent to the common eye. This is the hallmark of true market mastery. This is not a mystical ability, but a highly refined skill born from the consistent application of objective observation, meticulous analysis of price and volume, and the patient interpretation of the market's subtle cues. With enough dedicated practice, the discernment of accumulation and distribution, the recognition of changing character, and the feeling for the line of least resistance become almost second nature, guiding your decisions with profound clarity. Your personal market compass becomes your most trusted guide, allowing you to navigate the chaotic currents with confidence and precision. It empowers you to filter out the endless noise of news and opinions, to dismiss the distractions of emotional narratives, and to focus exclusively on the raw, unbiased truth revealed by the market's own actions. This internal clarity is invaluable, ensuring your decisions are always rooted in objective reality. This developed instinct allows you to anticipate, rather than merely react. You begin to sense the market gathering its strength before an explosion, or losing its momentum before a collapse. Your timing becomes impeccable, enabling you to position yourself for significant moves long before they are widely recognized, maximizing your profit potential while minimizing unnecessary risk. It is the culmination of disciplined learning. The ultimate triumph in speculation is not merely accumulating wealth, but achieving the intellectual freedom and self-reliance that comes from truly understanding the market on its own terms. Your personal market compass represents this profound mastery, allowing you to operate with an independent conviction, guided by your own discernment rather than the fleeting whims of the crowd or the manipulative narratives of the powerful. Ultimately, by cultivating this advanced observational skill, you transform the intimidating, often unforgiving, market into a realm of predictable opportunities. Your developed instinct for imminent moves, rooted in the market's hidden signals, ensures that you are always aligned with its most powerful currents, leading to consistent, formidable success and the ultimate, enduring satisfaction of true market mastery.